Or Arizona, right? Arizona.
Yeah.
Here we go. Welcome. You're listening to The Best of Investing on Talk 910. I'm your host, Edward Brown. I'm proud to have as my co-host Mark Hunt of Pacific Private Money, California's fastest growing mortgage investment firm, and Rob Spinoza of RPM Mortgage. Our phone number is 888-912-1190. Now, you're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. The vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. And those vacations are free. Their only request is a $75 cleaning fee to cover those housekeeping expenses. Today's trivia theme is Made in America. All right? Our website is bestofinvesting.com. Check us out on television, Comcast Channel 26 and AT&T Channel 99, Saturdays at noon, Sundays at 6 p.m. Now, we're all tired, and there's a reason for that. Mark, why are we all tired?
I just hate this whole daylight savings time thing.
I was here an hour early.
You know, this has been the worst week for me. I have been so disjointed. And, you know, it's just a lousy hour. So, you know, it doesn't make a whole lot of sense to me. You know, in my brain, I'm going, okay, it's an hour. What's the difference? But, you know, I've gotten really tired in the early evening. Then I can't go to sleep until midnight. And you got to get up, you know, what feels like the middle of the night. And it's almost painful. And then my wife tells me that, you know, that she just read an article like more heart attacks occur in this week than at any other time because it induces, you know, unnecessary stress to people.
Also, car accidents too in the morning.
Oh, right.
Yeah, that's a good point.
It's stupid. It's just so stupid.
I saw an interesting thing on Facebook of all places where it's a picture of an Indian chief. Did you guys see that?
No.
It says when told about the concept of daylight saving, he said that only the government would think that it would be possible to cut the top of a foot off the top of a blanket and attach it to the bottom of the blanket and have a longer blanket. That's a good one. I like that.
That's great. Well, what got us talking about this topic is that Robbie brought this little chart in that says the difference an hour makes.
Right.
Of course, they were playing off the, you know, as we adjust our clocks for daylight savings time, let's look what happens every hour in the housing market. So, and this is from the National Association of Realtors, and so every hour in the U.S., 550 homes sell.
No, that doesn't mean they're happening at 3 a.m. For those listening at home.
That's true. I guess it's just it's
concentrated
adjusted.
on Sundays.
Yeah,
just in general, what's going on?
126 homes regain positive equity.
At least right now, yeah.
The median home values go up $1.34. I love that. And prices rise 0.0007%.
Yeah.
Well, I didn't do the math.
Yeah, but not in gas.
I don't have a calculator
that
here, so I don't know what that actually means in terms of annual appreciation, but I guess it's probably somewhere around the national average, which is right now just under 5%.
Yeah.
So every hour, but I'd still love to have that hour back.
It's good talking. It's good that we're talking about this, though, because, I mean, you know, I remember 08, 07, 08 when things seemed to be in a free fall. And it's great to just have this stat in front of us. And I think that brings to light, you know, how resilient the real estate market is. And for the most part in the United States, I think that brings to light the value in real estate and also a lot about how things are cyclical in real estate. And that's a reality of it. You know, a lot of people right now talking about, is there a bubble? Have things risen too far, too fast? And, you know, this is talking about how incremental that actually is. And we have a little chart here that kind of goes into that too, that Mark and I were talking about before the show started.
Well, when you say, are we in a bubble, you know, is the market rising too far, too fast? It depends where in the U.S. you are, number one. And when you're talking about California, it's like where in California? And then if you're talking about the Bay Area, it depends on where in the Bay Area.
And even on a street. Where are you on the left side of the street? Right?
Well, and we've talked a lot about the tech effect, the Silicon Valley bubble, which really extends from San Jose all the way to southern Marin, because now that tech has infiltrated San Francisco and is the biggest, it's the largest economic, the fastest growing economic component in San Francisco is now the tech industry. We've got a lot of those tech millionaires and newly minted billionaires buying these outrageously priced homes in Tiburon and Sausalito in the 10, 15, 20, 25 million dollar range. So, you know, is there a real estate bubble? I believe there actually is a real estate bubble, pricing bubble, in many neighborhoods between Southern Marin and San Jose because of the tech effect. And I see that in loan applications that come to me. Now, my company is Pacific Private Money based in Marin County, and we make loans to real estate investors. We're a non-bank source of financing, so I see the alternative types of loans that come my way. So I'm not dealing like Rob is, and Rob can speak to the conventional market, and you probably see a lot of this yourself, but I have a lot of people who come to me saying, I need a second on my home for business purpose. I'm going to buy some inventory, or I'm going to do this, or I'm going to do that. There's a lot of entrepreneurs out there. Yeah. And so we had one recently come to us that owned a home in San Jose, in a nice neighborhood, but nothing special about it. And the house itself, there was nothing special about this house. In fact, if anything, it was on the dated side. Ranch style home, 4-bedroom, 2.5 bath, nothing special at all. He bought it in 2005 for $1.5 million. Wow. And he came to me with an appraisal saying the value today was nearly $2.5 million. And he had a $1.3 million first, and he wanted to borrow $300,000 for business inventory. Yeah, and I probably should have just said no just during the conversation, but we actually looked at it. We looked at it and studied it, but clearly that house will go back down to $1.5 million if anything were to happen. With the tech market.
How is that like in your business as you're looking at houses, looking at loans, where you're guesstimating that there is going to be a bubble? Are you assuming there's going to be a 20% drop, or how are you doing in your business?
Well, that's really hard to gauge. I mean, right now we generally don't provide more than 70% acquisition financing, so we're solving for 30% equity on a purchase.
Right.
Now, in a refinance, that's a completely different matter, because now you're talking about someone who's trying to pull equity out of their home. They're not coming to the transaction with cash, so they're coming to us with an appraisal that says, hey, I could sell my house today for, in the case of the San Jose property, $2.5 million. Well, maybe he could, but if in the next 12 or 24 months something happens unexpected in tech, and the tech bubble bursts, all the stocks go, crash, that all of a sudden that $2.5 million house will potentially go down 20, 30, 40, 50%. So you really have to be careful about that.
Especially since he wants a second on it, not a first.
Right.
So your position is right, but
my position is that I don't believe that equity is true. It's illusory equity based on a frantic market in certain submarkets of the Bay Area where tech is overbidding on prices, and they're chasing out the middle class, and they're willing to pay stupid prices because they don't care, because their money is funny money anyway.
Well, I went to the bank and said I wouldn't even sell my house for $20 million, but they didn't buy that.
Well, what I was going to say is that is what you're talking about, Mark, in those specific areas. That is being exacerbated by the fact that there's incredibly low inventory.
Yep.
Here in Marin County, you have less than 2 months of inventory on the market. So what that does is it compresses the price points where most people would be competing. So I know you've seen it, Edward, you've probably seen it as well. There was just a stat out about what do you have to earn in certain markets in order to afford a median-priced home. And it's as high as it's going to be here in San Francisco. Yeah. But now what happens is, let's say you take the median home buyer in the median range, earning the median salary, they're looking for these median homes. When they get pushed out by people who aren't playing in the median game, now you see price changes in what would be otherwise valued at a more normal level. I see that happening here in Marin, and you've got to be a little cautious of that on your side of things.
Absolutely.
All right, hey guys, we're going to cut to the first commercial break here. The trivia question is, the theme is Made in America. All right. What is the oldest clothing real retailer in America, dating back to 1818 in New York City? So again, what is the oldest clothing retailer in America, dating back to 1818 in New York City? Got it. All right, the first 3 callers with the correct answer win a free 3-day 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190. Make sure that you leave your email with us and answer that question. All right, stay tuned. Best Investing. We'll be right back.
So we can keep Woolworth. We'll go right back into this.
Okay. Yeah, it's
great. Talk about it. Woolworth.
I run Levi Strauss because
I know. I was going to say
when Sears started, Roebuck, when they started.
Oh, there you go. But they're
there was a catalog.
Sears Roebuck.
Oh no, they weren't. Where did they start at? I forget. You might be right about that, Greg.
But first thing came to mind is just what you said.
Woolworth. Yeah.
Or Macy.
Yeah. No, it's good. Edward's not telling.
I'm not saying
He's got a poker face.
Likes to keep us in suspenders.
That's it.
Exactly. Could you hold this up? I can't quite read.
So one of your points in there
Get
is
out of
cheating.
here. Can't be looking
This
at
one's
it.
pretty cool.
I
don't know if
do
you
that
remember
for
these
more.
guys.
You know me.
I do. Too old, too well.
Privlo. And basically what they're doing is they're looking at startup people. I'm going to contact the guy, Michael Slavin. I'm going to get in touch with him because he's probably got Fallout where they would be primed and I could get it. But he says, so they'll look at like a guy that's trying to start a business. So he's not
Financing
going
for self-employed.
Right. Well, not only self-employed, but guys that are trying to start up stuff. So they left probably a good job.
Is
and
it
they,
mortgage lending though?
it's
For
mortgage
the house?
lending, and he'll talk about habits online are very indicative. Like Privlo's research has shown that a person who uses Google Chrome is more likely to repay a loan than someone using Internet Explorer. So they're using all sorts of
Oh,
great
that is so funny.
he says rates between 5 and 10%.
Oh my.
But that is we can tie. I got to highlight it. You want it?
Yeah. So talk about bizarre algorithms. Oh my
Yeah, right.
goodness,
Can you
wow.
imagine what he's got in there?
Yeah, I just.
All right.
That's the hard part for doing this stuff is the development of the algorithms. How do you develop a program that becomes an app where you don't where you use as little subjectivity as possible.
Right.
That's why I have no fear about any of these startup companies. They're not going to take our business away unless they just get completely stupid and start lending to everybody. And they're going to lose.
Then they're going to lose their shirt. Yeah.
Okay, guys ready?
Yep.
Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and Rob Spinoza. When we got to the first commercial break, we asked this trivia question about Made in America. What is the oldest clothing retailer in America, dating back to 1818 in New York City?
Let's see. We guessed Sears, Macy's,
I said
and
Woolworth.
and then maybe it's something like Harry's Haberdashery or something like that.
No, Brooks Brothers.
Brooks Brothers.
Wow.
Yeah, dating back to
Boston.
1818. Well, it says New York City.
New York City.
So now, but before we get back to you, Mark, if you remember, last week we had a special trivia contest where the winner was going to get a 2-night stay at the Mount View Hotel. And if you remember, the Mount View Hotel, they're in Calistoga. They're a premier boutique hotel celebrating over 100 years of hospitality. They're a Zagat rated top U.S. hotels and spas. They feature luxury suites, private cottages, an award-winning spa to inspire romance, rejuvenation, and relaxation in legendary Napa Valley wine country. Voted best boutique hotel in Napa 2012, 13, and 14. Now get this, start with a continental breakfast in bed, like that already. Spend the day in a top-rated spa, take a dip in the healing waters of the mineral whirlpool, and lounge on a poolside cabana by the heated pool. I'm there, baby.
When do you check your email?
Yeah, Mount View.
Don't drive your wife crazy.
That's it. Call the Mount View Hotel and Spa at 800-816-6877. And so here was the trivia contest. Was in what movie was the license plate changed every time you saw the car? That would have been good. No, American Graffiti, Richard Dreyfuss' car. And our winner was James from Petaluma. But Petaluma, of course, big
That's right.
American Graffiti.
Yeah.
Yes,
You know,
that
good
was
job.
the backdrop for a lot of the movie.
Okay, so now
We were talking
Go ahead.
the last segment. We were starting to get into this, looking at this map of the United States that shows where real estate prices are today, state by state, in relation to what is generally considered the peak of the market. So if you assume, and this is a map from CoreLogic, and they're a great resource, and I use them a lot for my real estate research. And they use May of 2006 as the peak of
Right.
the market. And so now in California, and I've seen different numbers from different sources, but their map shows, or their sources show that California as a whole is about 14% under, still
right.
under where it was at the peak of 2000, May of 2006.
Well, actually, and if you look at the map, it shows the various points where it believes that the peak was. That's kind of interesting too. I didn't notice that initially, but yeah, you're absolutely right. May of 06 for California was its
Right,
peak.
and some of the super hot states that you remember, like Las Vegas, was in 2006, in fact, or maybe it was 2005, was one of the highest appreciating cities in America. Well, Nevada as a state is still 35% below the peak. Now, then you go to the Midwest and you start seeing states like Montana, Wyoming, Colorado, Texas, Oklahoma. They're all basically dead even because they didn't go up a whole heck of a lot and they didn't go down very much.
Yeah.
So, but the western states in general, Washington's still down 11%, Oregon down about 9%, Arizona down about almost 30% in Arizona. Another state that went up very, very sharply. People made a lot of money in Arizona and then lost a lot of money in Arizona.
But mostly Phoenix, though, right?
Well,
Probably,
yeah,
metropolitan area. Yeah,
exactly.
I would guess. But you know, there's a backstory to this too, because if you look at it right now, you see California again, like you pointed out earlier, Mark. Depends on where in California.
Right, because some markets have gone above.
Right,
Some
exactly.
of the Silicon Valley markets that we just talked about, from southern Marin down to San Jose, are well above
Right.
The last peak.
And
They're up 10, 15% above the previous peak.
If you're in some of those markets now, and let's say you bought at the peak, which I think a lot of people who did have become resigned to the fact that they'll never see that value back again. But if you bought at the peak, and let's say you used 100% financing, which was available back in 06, for those of you who will remember, even if we're down 14% now, if you've been paying down your loan, you may have a potential refinance opportunity there, depending on the terms of your loan and depending on what you appraise at. Because again, it depends where your property is located. So if you're stuck in a loan you took back in 06, and I still see that. I still will see people who originated in 05, 06, 07. Get in touch with someone, find out more about it, because if you're stuck in a loan that could be improved upon, that's still very encouraging news, because a lot of those areas were down a lot further than that at one point.
Yeah, no, absolutely. And one other piece behind these numbers is, if you're wondering, why inventory is so low and why unit sales are down in California still, it's because there's a huge percentage of the population that is still effectively landlocked, right?
Yeah.
They don't have enough equity, even if they're at where they bought it, there's no equity to sell.
And they're not headline news anymore.
Right.
But they're just hanging out, not selling.
I mean, how much equity do you have to have in order to sell and have enough of a down payment to buy another house?
Yeah.
Well, I've got 216 acres and a house and an observatory in Portal, Arizona, that I'm looking to sell. No offers yet. It's perfect for the astronomer.
And he's not making that up.
Yeah, I'm not making that up. And if you write to me, Edward at festoinvesting.com, and you're interested in 216 acres with a house and an observatory,
This is literally a once in a lifetime opportunity for somebody.
To say that it's a specialty property is an understatement.
All right.
And then the other part of that is the question I get a lot. Well, why isn't there any new construction?
Yeah.
And
permit fees.
Well, it's
Depends on where too.
There's there's not an easy answer to that. It's a combination of a lot of things. One of them is access to financing. Very difficult to find construction financing right now. Not a lot of people have all cash to go out and build homes. And there are people who are building homes. One home here, one home there. But that does not solve the tight inventory situation we have in California. I mean, we need thousands and thousands of new home units to be added on an annual basis
exactly.
in order to have a healthy real estate market. Well, that's just not happening because there isn't the opportunity. The opportunity is not there because we're still dealing with issues like house prices. Even though they've gone up, they're still not up enough to have it be profitable. Homes are expensive to build. The cost to build a home is still much higher than it was even 10 years ago. So now you've got the cost per square foot to create these new subdivisions. Believe me, that if the big 4 home builders, if there was a profit out here, there is plenty of unfinished subdivisions throughout California where the land they can pick up for cheap and keep building. But obviously the market is just not recovered enough yet.
Okay, well, I'll tell you what, we're going to cut to a break. When we come back, I want to get into our emails because we have a couple of pretty interesting ones here. One for Rob has to do with someone who paid all cash and now wants to refinance.
Yep.
And for Mark, about are there any times you can charge a smaller interest rate? Someone wants to borrow money from you, doesn't want to pay high rates. So
What's
we'll talk about
soft hard money?
Soft hard money, there you go. All right, so here's our second trivia question. Again, the theme is Made in America. Toy creator Stan Weston introduced which new toy in 1964 aimed at young boys? The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. Toy creator Stan Weston introduced which new toy in 1964 aimed at young boys? And tell you what, we're gonna next week we're gonna have another special trivia contest. Okay, and this time the winner will win an overnight stay at the Monarch Cove Inn, which is in Monterey Bay. So if you're looking for an idyllic weekend getaway or an unforgettable spot to celebrate life's happiest occasions, the breathtaking Monarch Cove Inn stands on a 100-foot cliff. That's a little scary, but I'm sure it's breathtaking. That'll take your breath away.
Yeah, that's right.
A 100-foot cliff overlooking Monterey Bay. It's 180-degree views span from New Brighton Beach to the southernmost point of the bay. Monarch Cove Inn has 9 rooms. Only got 9 rooms here. In an alluring Victorian house, as well as 2 cheerful standalone cottages. Each room has its own private amenities, including outdoor entrance. Breakfast brought to the room each morning. I love when they do that. Secluded on a quiet road, the Monarch Cove Inn is a relaxing few minutes walking to charming Capitola. You guys have been to Capitola? It's really great.
Yeah.
So check them out at monarchcoveinn.com.
Great area.
Okay. So we asked the regular trivia question. Stay with us. The best of investing will be right back.
Yes, you did. Had to check yourself there, huh?
Yeah, well, you know what? I was supposed to record this commercial and I forgot. I'm going to have to do it after our show and send it to them, figure this out. Blah, 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 blah. What happens when you keep
All right, so
Lipstick.
lipstick?
That little lipstick on
So
the
that
holder.
we can cover
But
that.
recycled cup.
Should I branch off the question?
That's funny.
He asked.
Yes, it
Talk about
is.
that a little bit.
I thought you were looking
Southern
in the water and
California
going,
It
Thrift
was.
Loans sees an opportunity in handing out home loans to professionals in the new gig economy who may be overlooked. We want to help create a stable mortgage industry. I love that. People just it's like a press release. We want to help create a stable mortgage industry. I could say that too, but
Hey,
that'd
if
be
you got a
lying.
performing loan at 7% right now, you're doing all right. I mean, you know,
Being able to get more creditworthy borrowers into the system and into the homes is a huge economic
Here's
stimulus.
where
I
they're
could say that too.
here's where they're going to have a challenge though. With this.
I'm gonna steal those quotes.
Those
That's
two-
my new quote.
Their target market is going to want to be taking $1.5 million loans, and they're not going to be handing those out to kids.
Yeah.
I mean, to basically, undocumented income situations, that's pretty risky.
So they won't disclose how much they've lent out thus far, or the number of borrowers it has served since its launch.
Privlo.
They've raised $10 million, so that's not a whole lot.
Yeah, they ain't going to get them very far in the Bay Area.
yeah, with one house.
Oh no, they've got $350 million in debt commitments to use for lending.
Oh, okay.
Well, commitments don't equal loans. So anyway,
I like my phrase, help me, help me.
Slavin's goal is to destabilize the mortgage industry. We've been living in an unrealistic environment since '99, where we all expect money to be free.
Here's an interesting thing, real fast. You know this disclosure law that's changing on August 15th?
Yep.
Okay. TRID. Till the rest but integrated disclosures. One of the things that now becomes law is you cannot require the borrower to provide income documentation to support their pre-qualification until you've disclosed to them. And once you've disclosed, the disclosures become binding. So basically, the law now says you can't require them to substantiate their income. You issue the pre-approval letter or the pre-qualification letter, and then if it falls apart when you actually get their returns, they're out of contract.
I'm so
But-
glad I'm not going to
but
do
you
QM
can't-
loans.
You can't require them to provide the income documentation
In order to give them that
until you've
letter.
disclosed the terms of their loan to them, which then bind you, the lender, to those terms.
Yeah, but if they lie to you, then they're out of contract anyway. I mean, you're not
Yeah,
bound
but-
by it. So so
They don't. It's not that they're lying. Sometimes they just. You get a self-employed guy who says he makes 10 grand a month. You look at his return and he makes 2.
well,
he doesn't know that.
He grossed 10 and he netted 8.
I mean,
Yeah. Well, but can't you explain that?
of
ahead
course,
time?
and we will. But I'm just saying, it's just now you make loss makes totally
Yep.
counterproductive.
All right, there you go.
Tax dollars work.
Is that going to affect you though?
No, because we make non-QM loans.
Yeah,
there you go.
So we're not looking for safe harbor.
Okay. There you go.
Mhm.
Well, welcome back to the Best of Investing. Again, I'm Edward Brown, your host, along with Mark Hunt, president of Pacific Private Money, and Rob Spinoza of RPM Mortgage. When we cut to the second commercial break, we asked this trivia question about Made in America. Toy creator Stan Weston introduced which new toy in 1964 aimed at young boys?
Well, I don't know, Stan, but I'm guessing G.I. Joe.
That is correct. I would have thought Legos, but the G.I. Joe, that is correct. Very good.
Good call.
Me and my brother used to play Army Men a lot.
Of course. In fact, we were graham crackers when we were kids, kindergarten. You know, you bite off part of it, turn it into a gun, and our teacher would say, "You're not allowed to do that." I mean, serious stuff. I actually had a friend who was
You are not well.
yeah, a friend of mine, unfortunately.
I'm surprised it was 64 before it was GI Joe. I would have thought it would have been right after the war. Anyway.
Yeah, I know. Yeah, me too. But interesting. I was just thinking about this because in '65, when I was in kindergarten, a new friend had come, and unfortunately, he didn't have a dad. His dad was one of the first Vietnam
Casualties.
casualties.
Wow.
Yeah, he was a helicopter pilot, and he was actually a war hero,
Wow.
but no dad. Let's see. Oh, email time. Okay, Mark, an email we got here says, "Are there times when you can charge a small interest rate, please?"
So I'm
I'm out of that
broker for a company called Pacific Private Money Loans, based in the Bay Area here, and we're an alternative to bank financing. We use private capital to make loans to both real estate investors and consumers. So we started doing consumer lending. Well, we've been doing it for a while, but quite a bit more in 2014 in response to Dodd-Frank, where there was a broader market created because Dodd-Frank made it much more difficult for banks and other traditional lenders to make traditional type loans to consumers. So we are providing both types of loans. The caveat to that is our source for private money, it's the same private individuals, and those same private individuals all over the Bay Area have been accustomed to earning a certain yield on the monies they invest in notes. So, for example, 10 years ago, it was not unusual for a person who invested in real estate secured notes to get anywhere from 10, 11, even 12% on their money. Now, that has gone down in recent years, but not as much as you might think or might hope. So, for example, nowadays it's much more common for a note investor to earn around 8%, maybe a little bit more, 9% sometimes, in rare occasions 10, but mostly between 7 and 9 is the typical range that we have to provide to our note investors to entice them to make their money available. So when someone says, well, so we get a call, and this happens every single day, and they give us their scenario, and particularly in consumer loans, because real estate investors, they kind of know what hard money costs. They expect us to say 10%.
Build that in, right?
And they build it into their, because it's a profit model for them. They're in business to make money in real estate. But a consumer's not. A consumer just got turned down from a bank. Now they call us, they call Pacific Private Money. And,
They were hoping for 3.5. Right?
well,
Yeah.
they were hoping for maybe 4 or 5.
Right.
And we tell them, well, we've got a program at 9.9%. They go,
Yeah.
well, can you do 7? Can you do 8? And
Sure, for 10 points. No, I'm just kidding.
and it's not that we can't do it, it's that we would have to spend an inordinate amount of time on their file trying to go to literally hundreds of different investors to see if we could find someone who liked their particular loan so much that they would do it for a lower rate. But here's the thing, why would they? They'll just wait for the next deal and earn more on their money. So we're not market makers when it comes to that. And unfortunately, the market is what the market is. In private capital, there's a huge gap between mortgage financing, traditional mortgage financing at, let's call it 4% right now, and private capital, which is anywhere from 9 to 10% on the note rate.
Mark, to what degree are your loans or the benchmark for your loans tied to, let's say, prime rate or something like that? So obviously, when prime was at 6, it was possible, I'm sure, for investors to then get what, 11, 12 on
Yeah.
a note?
Before I was a hard money lender, I worked in real estate development. I worked for a family-owned real estate development company, and when we used hard money, we went to a company who was prime plus 5.
Okay.
So that was a fairly typical.
Right.
And prime, I remember when prime was 8.
Right,
We paid
exactly.
13 for a loan, and when prime went down, and we would get hard money for a little bit cheaper. So, but now, ever since prime, fell through the floor and has been, dragging around at
3.25.
in the 3.25. It hasn't really factored in. Now, there are some lenders out there that have been doing notes at prime plus 8. But what happens when prime goes back up to maybe a 20 or 30-year historical norm?
Yeah.
That's going to make those loans outrageous. So
Yeah.
prime plus 5 was the old spread, and now there really isn't any.
It's go late on your credit card, because at that point you're going to be looking at 23%.
Yeah. So the answer is not no. It's just I really wanted to provide more of a backstory of what is why are private money loans priced the way they are? Why are they so high? And the answer is because the people who provide their capital for this type of investment have a certain expectation. If they don't get it from me, they're going to get it from somebody else.
Yeah.
Very good. And how do people get hold of you?
So Pacific Private Money, you can find us on the web at pacificprivatemoney.com. Call us and leave a message over the weekend, and we'll give you a call next week if you want to know about how to borrow money or how to invest a portion of your savings to earn 8% or more. We've got several investment programs, and we've got over 200 very happy investors. In fact, we're sending out all the 1099s and K1s. Actually, the 1099s already went out, but the K1s are going out now for our mortgage pool fund, and there's some large numbers that we're sending out to some of our investors. So give us a call at 415-883-2150. That's 415-883-2150.
And I'm one of those happy investors myself. See a big smile on my face. Before we get to you though, Mark, do you have any specific deal of the week or anything exciting you're working on?
Maybe I'll share that in the next segment.
Okay, all right, that's a good idea. Okay, Rob, getting to you. Let's see. Here's an email question we received. Because of how competitive the market is, I ended up buying a property for all cash. Now I want to refinance it and pay myself back.
Yep.
Can I do that?
Yeah. Okay. So we call that in the industry delayed purchase financing, and it is actually an exception on what is traditional financing, because typically within the first 6 months it was difficult, if not impossible, to take a cash out refinance. So if you bought a house in cash, you were stuck for at least 6 months, and then you could get cash out.
Yeah.
Now, what Fannie Mae has done is they've created an exception, which is called the delayed purchase finance exception. And within the first 6 months, within parameters, you can basically pay yourself back. So the rule of thumb on this is you have to act as if it were a real purchase. So if you're trying to trick the system, if you're trying to get funds from a source that would have not worked for your purchase, it's not going to work for your delayed purchase financing exception, okay? So what we'll typically ask for is a copy of the settlement statement from your purchase transaction. We'll want to know where the funds came from when you bought. And then if all of that checks out with guidelines, then you would be able to get it back. Now, we will use the appraised value. So if you buy a place, let's say you bought it in rough condition, you put some money into it, and now you want to get some money out, your appraisal value will be how we'll base the loan to value. But then you can get that money out. And we've seen that delayed purchase finance exception work not only as a Fannie Mae conforming loan, but now jumbo investors will also do that as well. It's a great way to do it. Yeah.
So how do people get a hold of you, my friend?
They can reach me at 415-367-5959. I'm with RPM Mortgage, work out of the Mill Valley office. And my bio is right on Best of Investing as well. So any information, even on the weekend, as Mark said, give me a ring, send me an email, and I'm happy to help.
So what about, we were talking about earlier about some of the inflated valuations we're seeing in some neighborhoods in the Silicon Corridor. Are those more difficult for you to finance, or if it just appraises, you just do it, then that's that?
Great question. So a lot of it depends on the loan size. So if it's a jumbo loan, then most likely you're going to have a single appraisal and then an appraisal review. Okay, so that is a function now of an underwrite for a loan. If it is a very large loan, there'll typically be 2 appraisals. Okay, large loan to value. And now also on the conforming side, Fannie Mae has introduced what's known as collateral underwriter, CU. And that is sort of an audit process that any appraisal will go through. When the value comes in and the appraisal comes in, it will be cross-checked against Fannie Mae's pool of data to make sure that a lot of things about that appraisal are what the bank needs them to be to create ultimately a saleable loan to the government-sponsored entities.
Are you seeing deals that aren't appraising, or are you not working that segment of the market?
I don't really work in that segment of the market,
Okay.
but it can happen. Absolutely, it can happen, and that doesn't mean it only happens at the low end. It can happen at the high end of the market as well, because you have more subjectivity up there. But more often than not, right now, fortunately, we're seeing a lot come in at or above the asking price or the contract price.
And so are you still able to do like 80% on those jumbos, or do they go down in LTV?
I'll give you an example. At RPM, we have programs that will allow a borrower to put as little as 12.5% down up to a purchase price of $2 million.
Wow. Wow.
Yeah, 15% down to over $2 million, and 10% down up to approximately $1.5 million. So it is aggressive. The terms on those loans are very good still, but it needs to be supported by the market. We're not going to do anything that is,
And you need a 6,000 FICO score for that one.
You will need a good FICO for a lot of those programs, and I will also say too that these are fully documented loans now, very much different than what we saw before. So the layering of risk is substantially different than it was when we were talking about the peak times like 2006. So a lot more scrutiny in the process.
Right. So forgetting for a moment about overpriced markets, just the availability of capital right now. There's some great loan programs,
Absolutely.
but you do need to qualify for them.
Yeah.
All right. Very good, guys. So we're going to go to our third and final commercial break. Again, the theme is Made in America. What did you just buy if it is a container with an image of a little girl in a yellow dress with an open umbrella? What did you just buy? The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. What did you just buy if you bought a container? If it contains an image of a little girl in a yellow dress with an open umbrella. Well, I didn't say open yellow dress. Okay.
That's next week's
Yeah,
trivia question.
stay with us. The best of investing will be right back.
It's either raisins or salt.
Morton salt, to be exact.
Is it Morton salt?
Yeah.
I couldn't figure out if it's sun-made raisins or Morton
Oh,
salt.
that's it. I didn't think of
Sun-made raisins, sun-made raisins. Something like that.
You know
I
what
thought you were going to talk about the little girl who shows crack. That's like tanning lotion.
Copper tone, right?
Copper
Yeah,
tone,
yeah,
that's right.
Funny. Okay, so yeah, we got a little over 13 minutes.
Good. So we can. I do have a deal of the week, and we can
Okay,
talk
good.
about mortgages for freelancers. So
Okay.
in fact, we might want to go into that because that's a good transition from the last one.
You know
And then
what
I'll
we
go
see,
into the deal of
you
the
know what we
week.
see still that you would not believe, given the amount of scrutiny, we're still seeing fraud. I mean, I've had 2 deals in the last year where we're highly suspicious of fraud on the and it's like, I don't think people realize it's a fucking federal offense.
Yeah.
I mean,
And they're definitely not reading the paper.
yeah.
Yeah, is it?
I had a woman recently who made an application and we couldn't get the verification of employment, and then my processor comes up to me and she's like, look at this pay stub. She's like, the amounts are exactly the same, but the ID number on the stub is different, and it doesn't look like it. So I called the borrower and I said, you need to do me a big favor. Tomorrow we need to have a conference call between you, your employer, and me. That night she canceled the loan application. Wow.
Yeah, that's an easy transitional way of saying, listen, lady, I know you're fraudulent and you're going to go to jail if you. Was she in a case like that? Is it just she's buying too much of a house, or
No, I don't know what I think his employment had changed or something, and maybe he just changed jobs or whatever. But they were trying to make it seem like it still was in place.
Yeah, but I mean, it's not like they were trying to steal money from you.
Well, they wanted a cash out refi.
Oh,
So
probably to get an appraiser on the hook.
Yeah, the cash out refis.
That's
those
the
are the
thing.
ones that are fraud. Yeah, cash out refis from Southern California. My hair.
You're
goes
like,
up.
hell.
Be careful now. Why are they coming up here? And
yeah, good point.
you
Good
know.
point.
Because everything's worth more up here. Okay. All right. Here we go. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark Hahn and Rob Spinoza. And this one was an easier question, it turns out. Made in America. What did you just buy if it is a container with the image of a little girl in a yellow dress with an open umbrella?
All right, well, I'll pick one and you pick the other. So I'll go with the Morton salt.
You got it, buddy.
That
I
is
think.
correct.
Yeah, all
Okay,
right.
not the sun-made raisins. Okay,
No, and what year?
Wow, that's way back.
1946.
1886.
What?
I didn't even know they had salt back then.
Yeah.
Okay. All right, Mark, you wanted to pick it up where we left off.
Yeah, well, we were talking about, Rob was talking about the availability of jumbo mortgages, and we were talking about how, it's in this era of Dodd-Frank now, it's much more difficult to qualify for a mortgage.
Yep. QM.
Right, but here's a new phenomenon, and not so new, because I'm sure a lot of people have been hearing about this. There's a lot of new tech companies springing up that are promising to break the chokehold that banks have on mortgage lending. And you've probably heard of Lending Club. They come under a lot of. There's actually about 20 different companies that I know of right now. Of course, not all of them will survive, but they all tend to have the same goal, which is to try to come up with some way of creating an algorithm and an application that makes it easier for people to qualify for funds. And
Building a better mousetrap.
Right, building a better mousetrap. And so Rob brought this article from National Journal that talks about a company that I hadn't heard about. And I don't know if we're pronouncing it right, Privlo, P-R-I-V like Victor L-O, Privlo. And their niche product are loans for the self-employed, for the entrepreneur.
But a subset of the self-employed, specifically those, what I infer from this are, tech people maybe that are creating startups. So basically, these are potentially borrowers who have worked for a large tech firm and they go out on their own. They're hoping to hit with their new application, site, product, whatever it may be, service. And what happens in that case, when you are a QM lender like RPM, you go to the borrower and you say, okay, we need your pay stubs, your W-2s, your tax returns, and they come back and they say, well, I just joined or I just became a part of this startup, and you don't have that history. You're basically ineligible for conventional financing at that point, because when you become self-employed, we require, in most cases, a 2-year history. So these people, by definition, with a startup firm, would not have that history of earnings. So this company, Privlo, has wisely identified that niche and is trying to provide a product to these individuals who otherwise will be turned away.
Right, because they don't have steady income. They might make a lot of
and
money.
they could have a lot of money.
They might
right.
make gobs of money
That's
in
correct.
fits and spurts, through
Right.
capital raises and paying themselves after a capital raise, or just having an uneven business or relatively new income.
All things that are typical of this type of environment we're in here in the high-tech Bay Area.
So what was interesting about the article, we got a chuckle from this, is that companies that are doing these web-based startups that hope to solve a problem, their challenge is to come up with a sophisticated algorithm to weed through all of the various applicants.
Duplicatable, kind of, provide some sort of basis for approvals.
Right, so they were looking at models to examine certain people's past consumer and credit histories and also their behavior. And so they make a statement here that they were looking at certain habits of people that would potentially qualify for their program, and they found their research showed that a person who uses the web browser Google Chrome is more likely to repay a loan than someone who uses Internet Explorer.
Oh my God!
Now, is that a true correlation, or is that what
I
it is?
use AOL. They won't give me 2 nickels.
Oh my God.
Netscape, or what was the one? I don't know.
Netscape, yeah.
I'm still using Netscape.
Although that guy's done okay for himself.
Yeah, that's
Mark
true.
Dreesen, or what?
Yeah, he's got a lot of money,
he
a
would
gorgeous wife.
he would have been the kind of guy that would have gone to Privlo to get a loan.
Yeah.
I mean, that's the irony of it all, right? So, but he hit, whereas others will fail. And these guys are now in the hot seat where they're going to try and identify who's going to win and who's going to lose, because they're going to be the ones lending the money to them.
I guess Zuckerberg could finally get $1 million loan because he's been with Facebook long enough. Okay, so Mark, give us the deal of the week.
So we were approached by a San Francisco family, very nice couple, who were living in a home that they had an option to purchase. And they had held this option to purchase for several years. And while they were living in the home, they had added $150,000 of their own cash to improve the property.
They're tenants.
Yes.
Wow, okay.
Can you believe that? Right. Well, they had an option to
Right,
purchase. So,
right.
so based on that option purchase is a contract. It's a unilateral contract. That the owner of the property has to sell to you under that contract if you exercise the option before the expiration date. So they had obviously they had paid option money. They were paying monthly rent, which included a portion of option money to the seller of the property, to the owner of the property, and they put $150,000 of their own improvements in. When they called us, they had unfortunately discovered that they could not get bank financing, and the reason was because there was an employment problem. They didn't have consistent employment, and so this was shocking to them. They did not imagine, particularly in San Francisco where prices had appreciated quite a bit, and so they came to us for a loan, and here's the other part of the problem. Their option price was $1.3 million. That's the amount of money they were able to exercise that option to purchase for and buy it.
And I'm going to guess it was worth $1.5 million or $2 million.
Well, they needed to raise $1.1 million. They needed to borrow $1.1 million to buy a $1.3 million home. That's 85% loan to purchase price. But here was the interesting news. We did an appraisal on that property, and we kind of knew beforehand where it was going to come in, and it came in pretty close to where we thought it was. The value of that home was $1.8 million.
Okay, so now you tell me how you based the LTV.
So we found a private party. We didn't do this through our fund, but we found a private party who was so very comfortable with San Francisco assets.
Yeah.
And again, a $1.8 million home is not a high-end home. We're not talking about bubble prices here. We're talking about a very nice home in the Marina District,
wow.
and at $1.8 million. I mean, very nice, but it's a small. It wasn't a huge home. And we found an investor who would do the loan, and we were able to close it for them, and they were just absolutely thrilled. I mean, they had,
that's great.
And we were thrilled to do it. I mean, these are the kind of feel-good opportunities that. And again, did they enjoy paying 9.9 on the note rate? No, but I mean, they were going to lose so much money. They were going to lose equity. And they were going to lose their cash in.
Yeah. How many points did they get charged?
That one was a 2-point loan.
So 9.9%, 2 points for a 3-year loan.
That one, we did this one on a bridge, but we can move them into
until they solved their employment issue.
Right.
Okay.
They believed that they had an exit. What was also interesting about the story is that the seller of the property got really upset at the end because he was convinced they were not going to be able to exercise. We had a hard deadline, and he refused.
When did they make
to
that?
go another day?
When did they make that lease purchase option?
I don't remember.
We said several years ago.
Yeah.
Maybe the owner could have done a seller carryback, but no, he wanted the property back.
He really wanted the property back.
So, but you know what, I'm going to say that's not a private money problem you have there, because that you're actually solving an issue for an item for them that would be anywhere, because if you have a contract price and you appraise above, the bank in a traditional scenario uses the lesser of the purchase price or appraised value to determine the loan to value. So that's not you guys weren't the ones, you were solving their problem. With that.
This was a great problem to be able to solve. I was really happy. I will say it wasn't easy to find that lender, and when they came to us, they didn't have the appraisal yet, so we had to order that, so we lost a little bit of time there, but the clock was ticking, and everyone in the office was nervous about it, and our star underwriter / office manager, Rick, was actually the guy that got on the phone and started dialing, and our investor database, now we've got over 500 investors in our database, of which over 200 have actually invested with us, and so but it didn't take too long.
That's what I love about the private person. That's what I love about the private money business, because you're making a sensible loan. Because at the end of the day, if you marketed that property, you'd be closer to 1.
Was there any minimum guarantee of interest, or you didn't have to worry about it?
Not on that one, no. On this particular loan program, again, Dodd-Frank passed a number of new laws that do affect sometimes the loans we make, and so included in that would be the fact that we no longer on consumer loans are able to charge a minimum interest guarantee, nor are we able to charge a prepayment penalty, default interest interest is also frowned upon nowadays, and a number of other smaller items.
You
Again,
still charge at least late fees, though.
yeah, we can still charge late fees, but like for example, on our real estate loans to real estate investors, they're usually due by the 10th, and if they don't pay by the 10th, there's a 10% late charge. Well, on consumer loans,
15
you have until the
15 days,
15th, and you're only allowed to charge a 5%.
5%,
Right,
4%
exactly.
on FHA.
Right, exactly.
Wow.
So again, and there's nothing right or wrong about that, because again, we want our people to pay on time.
Right.
We base our lending decisions based on the expectation that they're going to pay every month.
You're not in
because-
the business making late fees.
Well, no, right. Nor are we in the business of loaning to own. So
Right.
there are companies and lenders out there, which is why I think you have to be careful. You want to work with a reputable company if you're going to go private money or hard money, as it's called, because there are people out there who'd be happy to make you a loan, and they hope that you stumble, and because they will not hesitate to foreclose on your property. And in fact, I know people who have who've acquired the vast majority of the real estate they own by lending on it and foreclosing. So again, it doesn't necessarily mean they're a bad person, but it's a business model that I would be very uncomfortable with.
All right, we have just another minute. Any last
Well, I'm gonna jump right in and
All
use it
Yeah.
because they found I don't know who the source is, Career Bliss found that loan officers have one of the most satisfying professions in America. We are number 3 on that list. Can
Next,
you believe
next
it?
to dentist,
Yeah.
right?
Actually, I've got the list here. So
What is the
so
list?
The
Let's
list.
share it with
The number 1 is a principal.
School principal?
I guess so. Number 2 is an executive chef. Number 3 is a loan officer. And then an automation engineer, research assistant, Oracle database administrator, website developer, business development. I always thought those tech guys were sitting in a cubicle, just with the lights
Well,
on.
sometimes they're not even in cubicles now.
Yeah, just at a
sometimes they're
big
just-
table.
Not even that. They're on couches.
Wow.
Seriously, they just sit around on the couch, just kind of doodling and.
I'm surprised about the principal is the job satisfaction. They're obviously not talking to their students.
Yeah.
We didn't have a lot of kind of things to say about our principals back then. In fact, we had some nice names for him. Oh, that's
All right.
funny.
Okay, guys. Well, I'll tell you what. Let's cut to our thoughts for the day. Now, this one is a Greek proverb. All right. Eat and drink with your relatives, but do business with strangers. Good advice. It's almost like a Confucius type thing. And it isn't the number of people employed in a business that makes it successful. It's the number working. Yeah, how many people say I work
Tell
for
that
this
to the
company?
Greeks.
Right, how many are on Facebook?
Yeah, how many are on Facebook? That's a good one. All right, people, tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long.